Friday's jobs report was supposed to be a warning sign. Unemployment fell, but only because people stopped looking for work. Workforce participation shrank. By every traditional read, that is not a healthy labor market. And yet the Dow closed at a record high. The S&P added 1.76% on the week, and the Nasdaq outran everything at plus 2.12%. So the question you need to answer before Monday's open is this: is the market smarter than the headline, or is it making a very expensive assumption about what the Fed does next? Let's be precise about what Friday's report actually said, because the nuance here is where the money is made or lost. The headline unemployment rate ticked down. On the surface, that reads as strength. But the mechanism matters enormously. When unemployment falls because more people are employed, that is genuine economic expansion. When it falls because the labor force participation rate declines, meaning workers exit the job search entirely, that is a statistical artifact, not a victory. The denominator shrank. The ratio improved. The underlying reality did not. Labor force participation is one of the cleaner signals of long-run economic confidence. People enter the workforce when they believe jobs are available and worth pursuing. When they exit, whether through early retirement, discouragement, or structural shift, it compresses the measured unemployment rate while simultaneously signaling reduced productive capacity in the economy. Now here is what makes this week's reaction so telling. Institutional desks that run quantitative labor models know this distinction cold. They were not fooled by the headline number, and they bought anyway. That divergence, sophisticated buyers acting on data they know is mixed, tells you the bid was not coming from the labor report at all. The jobs data was almost beside the point. The real question is what these buyers are actually pricing, and the answer requires looking at what has changed in the Fed's communication posture over the last 60 days. Because if you believe a rate cut is coming before year end, then a softening labor market is not a red flag. It is a green light. The actionable read here: stop treating the unemployment headline as your primary signal. Watch participation rate trends over rolling quarters. That is the variable with predictive weight. The bad news is good news. Dynamic has been a feature of rate-sensitive markets for the better part of 3 years now. The logic is straightforward. Weak economic data increases the probability of Fed easing. Lower rates compress discount rates. Compressed discount rates inflate the present value of future earnings, and equities reprice upward. That chain of reasoning is not wrong, but it carries a failure condition that most retail commentary ignores entirely. The regime only holds as long as the market believes the Fed has room and willingness to cut without triggering an inflation relapse. The moment that belief cracks, either because inflation reaccelerates or because the labor market deteriorates fast enough to signal genuine recession rather than soft landing, the dynamic inverts hard. Suddenly bad news is just bad news, and the bid disappears. This week's VIX reading is instructive. The volatility index dropped 8.5% on the week. That is not a market bracing for ambiguity. That is a market expressing high conviction that the current macro path, gradual softening, controlled disinflation, eventual Fed flexibility, remains intact. VIX at these levels reflects an options market pricing in a narrow range of outcomes, not a wide one. The structural factor layered underneath all of this is the AI-driven capital expenditure cycle that has been compressing tech's cost curves while simultaneously expanding revenue addressable markets. That story has a multi-year runway, and it does not depend on any single month's payrolls number, which is precisely why Nasdaq outperformed the broader index this week by a meaningful margin. Tech's bid is partially macro, partially structural, and those two sources of demand are not the same thing. Understanding which is driving on any given day is where the edge actually lives. This is not financial advice. It is a framework for reading what the market is communicating. And right now it is communicating elevated confidence, not irrational exuberance. Here is where this week's data stops being historical and starts being actionable intelligence for the trading week ahead. Markets close for the 4th of July holiday. When they reopen Monday, the first hour of trading will function as a real-time vote on which narrative institutional money is committing to after a long weekend of reflection. There are exactly 2 coherent reads on this week's price action, and Monday morning will begin clarifying which one is dominant. Narrative 1. This is a Fed cut front run. Softening labor data has raised the probability of an easing move before year-end, and the rally is purely rate expectation driven. If this is the operative narrative, you would expect the rally to be fragile and highly sensitive to any Fed communication that pushes back on that timeline. A single hawkish statement, a hotter than expected inflation print in the coming weeks, and this move retraces with speed. Narrative 2. This is structural. The AI CapEx supercycle is generating genuine earnings growth in the technology sector. Corporate balance sheets remain healthier than in previous late-cycle periods, and the market is pricing durable expansion rather than a rate cut lottery ticket. If this narrative is dominant, the rally broadens. You start seeing cyclicals, industrials, and small caps participate, not just mega cap tech. The tell is in the breadth. Watch the advanced decline line on Monday. Watch whether Russell 2000 confirms or lags. Watch whether the Nasdaq's outperformance compresses or extends. A narrow tech-only continuation suggests the Fed cut trade is doing the work. Broad participation with rising volume across sectors suggests something more durable is priced in. Either outcome is informative. The market is always communicating. The question is whether you have the framework to read it before the move is already over. This week gave you the setup. Monday gives you the answer. We open this video with a contradiction. A labor market that looks mixed on the surface, and a stock market that did not care. By now you understand why. The bid was never really about jobs. It was about what jobs data implies for Fed policy and what the AI CapEx cycle is doing underneath all of it. The real test comes Monday. Here's the follow-up question. If the rally broadens next week, does that change how you should be positioned in small caps going into Q3 earnings? That is the next video. Subscribe so you do not miss it.